If you find yourself looking at the price charts, looking at the price of gold, thinking something's different, something has changed, well, you would definitely be right. Goldman Sachs just raised its price target for gold to $2,700 by the end of the year. But previously, they had it at $2,300. Why do we care? Well, for a big bank to increase its price target on a shiny rock by 17.5%, something big has to change. Now, some people might think an adjustment like that is just obvious. The price just shot to $2,460 on Friday, so $2,700 might seem like an easy target. Well, that's just not the case. Around $2,700 in the midst of hot inflation data is not normal. So let's back up to what was happening 6 months ago. If we saw inflation data coming down, investors expected the Fed to cut rates sooner. That would send gold price higher. If we saw inflation coming in hotter, investors expected the Fed to keep rates higher. That would send gold prices lower. Well, what we're seeing is inflation coming in hotter and prices going up. So it's no longer doing what it did 6 months ago. Everything has changed. Before we get into it, though, if you're looking for gold or silver, check out SD Bullion. New buyers even get gold or silver for spot. That's sdbullion.com/new. So what's changed is that we're in a bull run now, a bull cycle that could last a year, it could last 6 years, it could last more, who knows? The part we do know, though, without any doubt at all, is that the primary factors affecting gold price 6 months ago are no longer the primary factors today. Now, I mention this because we kind of need a reboot here. Even though I started this channel right on the verge of a pretty significant gain in gold price, there's always been one significant factor or another slowing gold down. We've seen gold go from the 1500s when I started this channel to around $2,000 and then just get rejected over and over. And not that a 25 to 30% gain is nothing, but this was during a global pandemic at a time when all you had to do was throw a stick to hit a guy telling us gold and silver were going to the moon. Now, if we look back at retail buying, at physical gold and silver or ETFs and other derivatives, we saw sales from the big mints spike. We saw the same thing with bullion dealers, and we saw big inflows for ETFs. So the price gains that we saw were pretty well supported by live sales data. Now, add some institutional buying to that. If you think back to the new Basel III changes, making gold a Tier 1 asset and also requiring physical storage for it to qualify, we could probably map some of the price gains back to new physical holding requirements. Point being, it wasn't all retail buying, but it was all pretty straightforward. It all made sense. So where I'm going with all this is the retail buying could be seen in mint sales. It could be seen in ETF trading volume. But if we look today, that just doesn't line up. We're not seeing a notable increase in U.S. gold bullion sales. If you look at the sales figures for American Gold Eagles, they're just not really going up. ETFs have had net outflows. So if you're trying to find the specific reasons the price of gold is on such a significant run right now, good luck, because again, it just doesn't line up. At least not if you're looking for the things moving it previously. Okay, so what does it all mean? Well, there is a before and an after, at least to me. So gold moved one way before, say, October of 2023, and you might not have agreed with what it was doing, but the reasons could at least have been seen. Now, since then, it's moved a different way. The hope rally for the Fed rate cuts, that took gold on a run. It was no longer about what was actually happening. It was about what investors hoped would happen. And we'd hear that analysts were puzzled by gold's performance early this year. Well, now look at February 29th. We've gone from gold price moving away from fundamentals running on hope to a new model entirely. So this is the reboot that I'm talking about. This is something new. The data just doesn't make sense, and the old questions don't even apply. It isn't about mint sales or bullion dealer sales. This is all out bull territory. The question now isn't, why is the price of gold rising? It's more, why is it rising now when it wasn't previously? So the best answer we have to the question is central bank buying. We've got dollar devaluation. That was kind of the popular theory for why gold and silver were going to shoot the moon. And maybe that idea isn't too far off. There's probably a little bit of truth to it, but not to the scale that the doomers would have had us believe. Some people want you to think the end is always near. But if you take a look at the related ideas like de-dollarization and deglobalization, well, it starts to make more sense. It lines up with why central banks would be buying gold at historic levels. So de-dollarization, You've got certain countries holding fewer US dollars and more gold in reserve, and then deglobalization. Well, you just have certain countries trading less with the US or trading less with the US dollar. So maybe that shift, the deglobalization, the de-dollarization, all of that makes sense. Maybe it even seems obvious today. Like maybe it was just a matter of time, and those old theories that the end is near, well, maybe it feels like they were right too. Hey, gold is on a huge run. It must be something, right? Well, I think we need to stop and make sure we all get that what's causing the run is not the retail buying I mentioned earlier, the typical institutional buying, and it's not that the end is here. We have big changes globally, but this is a case where it can actually see gold take off without everything else going down in flames. So new information, and it has to change the way we think about gold and how the price might move. So speaking of movement, it can go both ways. So the question that I've been asking is what might slow this price rundown? Now, based on new information, we could make a list. We could say the Ukraine conflict could be resolved. The Middle East conflict could settle down. China could get their act together in terms of growth and money could flow back into their real estate sector. Or you could have central banks just stop buying gold. The one other thing that could happen is Fed policy here in the United States and elsewhere could turn back around. We could go back to hawk mode and see rates rise. And without one or more of those things happening, there's really no good reason that we would think that gold price should drop significantly. So if you're Goldman Sachs and you're publishing a price target for gold, you're probably pretty doubtful that any of those things are going to happen to slow down gold, and $2,700 is probably a pretty easy price target to make. I mean, Citi is in on this now too. They're saying $3,000 in the next 6 to 18 months. Now, personally, I'm not making predictions for the year, and I'm not an analyst anyway, so if I was, you should be a little bit suspicious. But I want to slow this down. I want to kind of restate what I just mentioned. The factors that I've gotten used to looking to for clues on gold price have all changed. My questions have changed with it. So it's no longer what might make gold price go up. It's actually what could slow it down, what might actually turn it around. And honestly, I'm not seeing much. So when anyone says that we're officially in a bull run now, analyst or otherwise, I have to agree. So let's call it good there. Let us know what you think of Goldman Sachs' $2,700 target for 2024, maybe Citi's $3,000 target for the next 6 to 18 months. Is that conservative, right on, something else? Let us know. And then while you're in the comments, be sure to hit the like button if you found any of this interesting. Be sure you're subscribed with notifications turned on if you want to hear more on the topic. And if you're still here, thanks again for watching. I always appreciate your time. Take care.